CGDVs crushing SCHV with 25% versus 18, but you're paying 8 times more in fees for less income. Worth it? CGDVs crushing SCHV here, 90% versus 68% over 5 years. That's a 22-point gap widening steadily. CGDV crushed it with a 25% return over 12 months. That's the kind of performance that separates winners from the pack. SCHV's 18% return trails by 7 points, a gap that really stings when you're counting on those dividend checks. Think of it like race cars on a track. CGDV crossed the finish line 7 percentage points ahead. Both gained ground, but one had the horsepower advantage. CGDV's 91% 3-year return is phenomenal. That's the difference between rebuilding your portfolio and truly building lasting wealth. CHV's 43% return is solid, no doubt, but it's nearly half what CGDV delivered in the same time frame. CGDV's 90% 5-year return isn't luck. It's consistent outperformance that proves this ETF has a real, sustainable edge over time. SCHV's 68% gain over 5 years is respectable, but it's clearly trailing behind the competition in this race. CGDV's consistent wins across 1, 3, and 5 years prove staying power. Like a marathon runner who doesn't just finish first once, but dominates every race they enter. Raw returns look impressive on paper, but they miss the volatility story. How rough was the ride getting there? CGDV's Sharpe ratio of 0.9 means you're earning stronger returns without taking on excessive risk over 5 years. SCHV's Sharpe ratio of just 0.5 means it delivered half the risk-adjusted returns compared to CGDV over this period. The Sharpe ratio is like fuel efficiency for your money. CGDV delivered better returns per unit of risk taken, same journey, but way smarter use of your risk budget. A Sortino ratio of 1.9 means CGDV delivers strong returns while keeping downside swings in check. Exactly what investors want. SCHV's Sortino ratio of 1.0 shows it struggled with downside risk, less than half the protection you'd want during market drops. CGDV crushed its benchmark by 5 percentage points every year for 5 straight years. That's genuinely impressive outperformance. SCHV's negative alpha shows it couldn't even match passive exposure. You're getting slightly less return for the same risk profile here. Think of alpha like a report card comparing performance to the class average. CGDV scored 5 points above average, while SCHV fell slightly short. One fund earned its keep, the other didn't. Understanding drawdown and recovery time reveals the real price you'll pay during market crashes. Pain tolerance and patience required. That 22% crash stings harder than you'd think. 2 percentage points can mean thousands more lost when markets tank. Time to weigh in. Which funds got your vote, CGDV or SCHV? SCHV's 20% drop sounds better than that massive crash we just saw, but it's still a significant loss to stomach. Maximum drawdown is like riding a roller coaster. Both funds dropped from their peak, but CGDV fell 2 percentage points further. That extra drop feels much bigger when it's your money on the line. CGDV bounced back to break even in just 8 months. That's the kind of quick recovery that keeps investors sane during rough patches. 486 days to break even. That's patience most investors don't have when they're watching their money stay underwater. CGDV bounced back in just 245 days, while SCHV limped along for 486. Speed beats size when you're recovering losses. Think of recovery like weather patterns. CGDV hit harder but cleared in 8 months, while SCHV was gentler yet hung around twice as long at 16 months. Different storms, different timelines. Income investors focus on 2 key numbers: how much cash you're collecting now and whether that paycheck keeps growing. SCHV's 2% yield is a lifeline for retirees who need that steady income hitting their account every quarter. CGDV's 1.3% yield looks modest now, but here's the twist. Patient investors bet on dividend growth overtaking that low starting income. CGDV's dividends jumped 33% in 3 years. That explosive growth more than compensates for its initially lower yield. CGDV's crushing it with 90% returns over 5 years and better risk management. SCHV trails at 68%, offering higher current income but slower growth and tougher recoveries when markets drop. SCHV's 6% dividend growth over 3 years is steady, but it clearly can't match CGDV's aggressive pace here. SCHV gives you 2% income right now, but CGDV's 33% growth rate means your dividend income multiplies 5 times faster over time. Think of it like leaves growing. SCHV gives you more dividends today, but grows slowly, while CGDV pays less now, but its growth rate is 5 times faster. Fees are silent killers. They chip away at your returns year after year, and the gap between funds adds up fast. SCHV's 0.04% expense ratio is incredibly cheap. You're keeping almost everything, making it one of the most cost-efficient dividend funds available. CGDV's 0.33% fee is 8 times higher. That difference quietly eats into your returns year after year, compounding the drag. CGDV's higher fee paid off massively, outperforming the cheaper fund by 22 percentage points over 5 years, despite costing 8 times more. CGDV's higher expense ratio is like choosing the scenic route on your road trip. You pay extra gas money, but reach better destinations with richer experiences along the journey. CGDV's tech exposure drives its outperformance, while SCHV's heavier financial services weighting drags it into slower growing sectors. CGDV went all in on tech at 28%, perfectly positioned to ride the AI and cloud computing wave upward. SCHV's 15% tech allocation means you're getting only half the sector's growth potential compared to broader market exposure. Like a racing athlete specializing in sprints, CGDV doubled down on technology. When tech stocks surged, this focused training paid off bigger than well-rounded approaches, amplifying both victories and risks. SCHV's putting 22% in financials, steady dividends from banks and insurers, but don't expect tech-level growth here. CGDV's 6% financial services allocation proved smart here. Staying underweight meant dodging the sector's drag when it mattered most. CGDV's 28% tech bet crushed SCHV's 22% financials play. Opposite strategies, opposite results. Tech won this round decisively. Think of it like choosing restaurants. SCHV's the slow service diner, while CGDV's the fast casual chain. Both get you fed, but one moves quicker when you're hungry for returns. Concentration risk reveals how managers think. Fewer holdings means stronger conviction, while mega-cap bets show faith in market leaders. CHV holds 559 stocks. Great for safety, but that massive diversification means your best performers barely move the needle. CGDV's just 54 holdings mean it's 10 times more concentrated, amplifying your wins when it's right, but your losses when it's wrong. SCHV spreads its bets across 559 stocks, while CGDV goes all in on just 54. That's a massive concentration difference. SCHV's spreading risk across 559 holdings, while CGDV concentrates on just 54. It's the classic egg basket dilemma. Fewer baskets mean higher stakes, where each pick carries significantly more weight in your portfolio. CGDV's strategy is crystal clear. 40% sits in mega caps, and that massive bet on giants drove its outperformance. SCHV's 12% mega cap allocation meant it missed out on the market's biggest winners when they mattered most. CGDV crushed it with 40% mega cap exposure, while SCHV only managed 12%. That's how you capture upside when giants dominate. Here's the egg basket lesson. CGDV bet 40% on mega caps, the strongest basket, and won big. SCHV spread eggs everywhere and got modest returns. Concentration beats diversification sometimes. SCHV gives you safety through diversification and steady income. CGDV bets big on conviction with stronger returns and explosive dividend growth potential. Think of it like pizza slices. SCHV spreads your money across more companies but smaller positions, while CGDV concentrates on fewer high-quality holdings. Different strategies, different risk profiles. CGDV's concentrated strategy delivered on all fronts: superior returns, better risk management, faster bounce backs, and explosive dividend growth. That's a clean sweep. CGDV checks all the boxes: lower fees, higher yield, broader diversification, and smaller losses when markets drop. Stability wins. So which fund's right for you? SCHV if you're conservative wanting steady income. CGDV if you're chasing explosive dividend growth. SCHV's your steady marathon runner. Reliable, consistent miles without the drama. CGDV's the sprinter, chasing faster times, but you'll feel every bump along the way. The legal fine print, because nobody's liable for your investment choices here, friends. That's a wrap. Hit subscribe if you want more ETF battles, weekly breakdowns that cut through the noise with real data.